Hello everyone. In this video, I'm going to go over 8 super useful insights about investing. Whether you are a beginner or an experienced stock trader, I think you'll learn at least a few things you might not have known before. Let's dive in. First, the importance of starting early. Lessons from experienced investors. Starting to invest early can have a huge impact on your financial future. Just imagine if you had invested $100 a month starting at age 25. By the time you reach 65, that investment would have grown to over $200,000. But if you wait until you're 35 to start investing the same amount, it would only grow to just over $100,000 by the time you reach 65. That's why experienced investors always stress the importance of starting early. They know that time is one of the greatest assets in investing. So let's learn from their wisdom and start investing as early as possible. You don't have to have a lot of money. Just start small and gradually increase. The earlier you start, the better off you'll be in the long run. Second, diversification is key. Understanding asset allocation. When it comes to investing, it's important to not put all your eggs in one basket. Diversifying your portfolio, also known as asset allocation, can help mitigate risk. Imagine if you had invested all your money in one company's stock 10 years ago, and then that company went bankrupt. You would have lost all your investment. But if you had a diversified portfolio with a mix of stocks, bonds, and real estate, the impact of that one company's bankruptcy would have been greatly reduced. That's why experienced investors always emphasize the importance of diversification. By spreading your investments across different asset classes, you can reduce overall risk. So let's take a closer look at the different types of assets and how to allocate them. By understanding and implementing asset allocation, you'll be one step closer to a successful investment portfolio. One easy way to achieve diversification is through index funds. Index funds are a type of mutual fund that tracks a specific market index, such as the CF 500. There are different types of index funds, including stock, bond, and real estate index funds. For example, a stock index fund might track the CF 500, giving you exposure to 500 of the largest companies in the U.S. And a bond index fund might track the Barclays U.S. Aggregate Bond Index, providing you with a mix of U.S. government and corporate bonds. One of the biggest advantages of index funds is their lower fees compared to actively managed funds. Actively managed funds often have higher fees due to the investment managers constantly buying and selling securities. With index funds, you get exposure to a broad market with little to no active management, resulting in lower fees. Some specific examples of popular index fund types include the Vanguard SEP 500 Index Fund, the Schwab U.S. Broad Market ETF, and the iShares Core U.S. Aggregate Bond ETF. By investing in these types of index funds, you can gain diversified exposure to U.S. stocks, bonds, and other assets at a low cost. Third, the power of compound interest. How small contributions can grow over time. The magic of compound interest is that even small contributions can grow into a substantial sum over time. Think of it like a snowball rolling down a hill, starting small but gaining momentum and size as it rolls along. Imagine you start contributing $100 a month into a retirement account that earns an average annual return of 7. After 10 years, your account balance would be over $15,000, and after 30 years, it would be over $76,000. This is the power of compound interest, where your investments not only earn a return, but also earn the interest on the interest from previous periods. By starting early and consistently contributing, even small contributions can grow into a substantial sum over time. Fourth, avoiding common investment mistakes. Lessons from financial advisors. Have you ever heard the saying, "There's no such thing as a free lunch"? Well, the same goes for investing. Many people fall into the trap of thinking they can get rich quick, but unfortunately, that's just not the case. To help steer clear of common investment pitfalls, we talked to several financial advisors to get their expert insights. From chasing hot stocks to not having a diversified portfolio, these advisors have seen it all. And they've shared with us some valuable lessons to help you avoid these common mistakes and reach your investment goals. First, it's important to have a well-diversified portfolio, spreading your investments across different asset classes, sectors, and geography. Next, avoid trying to time the market and making impulsive investment decisions based on short-term news or events. Instead, focus on a long-term investment strategy and stick to your plan, even during market volatility. It's also important to have a clear understanding of your investment goals, risk tolerance, and time horizon before making any investment decisions. Finally, don't be afraid to seek help from a financial advisor who can provide professional guidance and personalized advice to help you achieve your goals. And the fifth, understanding risk V's. Reward. Balancing your portfolio. Investing is not just about maximizing returns. It's also about managing risk. Risk and reward go hand in hand in the world of investing. The key is to find the right balance between the two that aligns with your investment goals and risk tolerance. By having a balanced portfolio with a mix of low, medium, and high-risk investments, you can potentially maximize returns while minimizing risk. Remember, it's not just about the returns you make, it's also about the amount of money you get to keep in the end. Here are examples for a high-risk, high-reward portfolio, a low-risk, low-reward one, and a balanced portfolio combining aspects the first two. So, high-risk, high-reward. Investing in individual stocks such as Tesla or Amazon, which have the potential for high returns, but also carry a higher level of risk. Investing in emerging market stocks, which can offer higher returns, also come with greater volatility and currency risk. What is low risk, low reward? Investing in savings accounts, which offer low interest rates but also provide low risk to your capital. Investing in bonds, which generally have lower returns but also provide a lower level of risk compared to stocks. And now, a balanced portfolio might consist of a mix of individual stocks, bonds, and index funds. For example, 60s in stocks, 30 in bonds, and 10 in real estate investment trusts, REITs. This type of portfolio aims to provide a mix of higher risk investments that offer higher potential returns, balanced with lower risk investments that provide stability and preservation of capital, leading to the sixth, preservation of capital. Preservation of capital refers to protecting the value of your investments from loss or decline. It's a critical aspect of successful investing, as you don't want to see the value of your hard-earned money decrease over time. To achieve preservation of capital, consider investing in low-risk assets such as bonds or high-quality blue-chip stocks that have a history of steady growth. For example, if you are a conservative investor, you could allocate a portion of your portfolio to bonds issued by the U.S. government or high credit-rated companies. By doing so, you can potentially reduce the risk of significant losses, even if it means sacrificing some potential gains. Remember, the goal of preserving capital is to ensure you have money to fund your future goals, such as retirement or a child's education, without having to worry about market fluctuation. And 7, make allowance for your own psychology. Here's the important thing. You have got to make allowance for your own psychology. Now, all of us have gotten that idea in our heads. This stock or this investment or this token is the real deal. You think it might give you 10 times the returns. Well, you know what? It might, at least for a while. So you've got to give yourself permission to go for stuff like that. So you assign 2 or 5 of your portfolio for these long shots. If they pay off, then awesome. If not, well, all is not lost. You still have 95 of your portfolio in stable, return-generating funds. This trick is one of the most important ways you can do that really important thing we talked about earlier, preservation of your capital. And the 8th, maximizing your retirement savings, understanding 401k and IRAs. You might already know this, so feel free to skip ahead if so, but this is the lowest hanging fruit in this list. Just do this. The government has provided the option of 401ks and IRAs to help individuals save for their retirement. One of the biggest benefits of 401ks is that many employers offer a matching contribution, meaning they will match a portion of your contributions. This is essentially free money. So it's a no-brainer to take advantage of the employer match if it's available. 401k contributions are made pre-tax, so you can lower your taxable income and potentially lower your tax bill. With IRAs, you have the option to make either traditional IRA contributions that are tax deductible or Roth IRA contributions that are taxed up front but grow tax-free. Both 401ks and IRAs provide tax benefits, allowing your savings to grow more quickly. In summary, maximizing your retirement savings through 401ks and IRAs is a smart way to prepare for your financial future and potentially reduce your tax bill. And the last but not the least, the importance of monitoring your portfolio. Staying on track, monitoring your portfolio is crucial in ensuring that your investments are performing as expected and aligned with your financial goals. Regularly reviewing your portfolio allows you to identify any underperforming investments and make adjustments as needed. For example, if a stock in your portfolio has not met your expectations, you may want to sell it and reallocate the funds to a more promising investment. Staying on top of your portfolio can also help you identify market trends and adjust your strategy to potentially maximize your returns. Consistent monitoring also helps you to stay disciplined and avoid impulsive decisions based on emotions like fear or greed. In conclusion, regularly monitoring your portfolio is an important part of successful investing and helps you stay on track to reach your financial goals. So what are the takeaways and action items for you in all this? Investing is a crucial part of building wealth and achieving financial success. Diversification is key to reducing risk in your portfolio and maximizing returns. It's important to understand the difference between high-risk, high-reward investments and low-risk, low-reward investments to create a balanced portfolio. Preserving your capital is a top priority in investing and can be achieved by avoiding common mistakes and regularly monitoring your portfolio. Maximizing your retirement savings through options like 401ks and IRAs can provide tax benefits and take advantage of employer matches. Staying on top of your portfolio and monitoring its performance is crucial in ensuring that your investments are aligned with your financial goals. By following these key takeaways, you can make informed decisions and take control of your financial future. Don't let fear or lack of knowledge hold you back from investing. Start taking control of your financial future today. Please subscribe to the channel and give this video a like to show your appreciation. The algorithm loves it, and you know what? So do we. Thank you.